What if I told you that your investments could be losing you money every single year and you wouldn't even know it because you can't see it on a statement? Well, what I'm referring to is called tax drag. And it's one of the most overlooked threats to your long-term returns, especially in a taxable account. And just to be clear, I'm not talking about tax loss harvesting. That's a separate topic. This is kind of a subset topic under that. And it's something I'll probably address in a future video, but I'm talking about tax drag. Again, it's a concept that most investors haven't necessarily heard of, but one that quietly chips away at your returns every single year. So in today's video, we're going to break it all down for you. What exactly tax drag is, how it works, and most importantly, how you can minimize it. Because if you're a long-term investor, like we see with a lot of our clients, understanding tax drag isn't necessarily optional. It's kind of important. So stick around until the end of the video and I'll walk you through real life examples that show how the right investment choices can save you thousands in taxes over time. In the meantime, let's dive in. Let's start with the basics. What is tax drag? Tax drag is the reduction of your investment returns, which is caused by taxes. This is usually triggered by interest, dividends, and even capital gains. I would say think of it like slowing down your headwinds in terms of generating long-term wealth. So here's a simple example. Let's say your investment returns 8% every single year, but after that investment has paid interest and dividends and capital gains, your real return is really only 6%. That 2% difference is your tax drag. And while 2% might not seem like a lot, over time, it compounds and again, eats away at your long-term wealth. And again, you can't even see it. I bring this whole topic up because, I mean, listen, Sanders Smith as an advisory practice, we're in the Northeast, we're in the New York metro area, just outside of New York City. So we're dealing with a lot of typically higher income earners in a very highly taxed area, whether it's New York, New Jersey, or Connecticut. So a very common question that we get as advisors is, hey, how do I become more tax efficient? How do I pay less in taxes? And it's not very easy, especially for a W-2 employee. There's no magic solution. So you just have to do little things along the way. And this is one of them. But the problem is that most people don't even know about it or realize it. So to sort of pull it all together, we just brought in a new client a couple weeks ago and we were transferring everything over. And sure, we're going to look at capital gains and losses and if the allocation is right and things like that, as we're cleaning the portfolio up. But we're also looking at what types of funds do they have in that particular account. So again, we're just referring to really taxable accounts. And when I say taxable accounts, I mean just your traditional investment or brokerage account, not a retirement account. And so it's not to say that some of the funds that they have or that somebody could have is not good. It might be. But again, depending on if it's a mutual fund or an ETF, which I'll get into in a little bit, you could have this silent erosion of returns that you didn't even know was there. And it's just small, subtle tweaks that we make or even you can make when putting your portfolio together. And I think another thing that we see a lot of times is that people will own mutual funds that they bought 5 years ago, 10 years ago, 15 years ago. They didn't necessarily know why they're buying it, just that some publication or someone told them that it was something good to have. So they bought it, but didn't understand the long-term ramifications of it. So when we talk about tax drag, again, we're not saying that any of the investments are bad. But again, there's a silent drain on your returns if things aren't structured correctly. So what exactly triggers tax drag? The first thing to consider is really dividends and interest income. So whenever your investments generate dividends or interest, so think a mutual fund, an ETF, maybe it's an individually owned bond or a single name stock, you're potentially triggering a tax bill. It's not you who's doing it. It's actually, especially if you own an ETF or a mutual fund, it's the manager of those specific funds, which you don't have any control over. We've talked about this and I'll kind of highlight this in a previous video where I talked about separately managed accounts and being able to control your taxes, especially from a tax loss harvesting perspective. Qualified dividends, usually from U.S. stocks, are taxed at favorable long-term capital gains rates, whatever they might be in that given year. But non-qualified dividends, like those from REITs or some international funds or stocks, are taxed at ordinary income, which could be as high as 37% federally. Then there's interest income from bonds, CDs, money markets, again, fully taxable at ordinary rates. So even if your portfolio is growing, the IRS is getting a piece of that growth. And number two, high turnover. So whether that comes from ETFs or mutual funds, which generally equal frequent capital gains. So again, think of this as like if you own an ETF or a mutual fund where you can't control what specific security they're holding, you just own that underlying, or you own a share of that particular fund, but there's a management team who's making all of the decisions on the back end. If that particular manager is frequently buying and selling holdings, that's considered high turnover. So every time something is sold, and maybe it's sold at a gain, those gains are getting passed to the shareholder. And then you get taxed on your shares, whether or not you sold that particular share or not. So the higher the turnover in a fund, or even in your portfolio, the higher the chances that you're going to owe taxes each year, even if you didn't touch your account. To extend upon this, number 3, mutual funds versus ETFs. And this is a key distinction that I've been sort of alluding to the whole entire time. So mutual funds are usually less tax efficient than ETFs. But why? It gets a little complicated. I won't get into all of the nitty-gritty, but it really comes down to how redemptions are handled within that particular fund. When you sell a mutual fund, the fund manager actually might need to sell the holdings to raise cash. And if those sales trigger gains, the tax impact is spread across all shareholders, even those who didn't sell. So if we contrast that with ETFs, which use a unique structure called in-kind redemption. And so that's when big investors redeem ETF shares. The ETF doesn't sell anything. Instead, it transfers the underlying shares of the underlying stocks to the redeemer, which means that no capital gain is realized by the fund and no tax bill is passed on to you. So that's a very high-level explanation of why ETFs are generally considered to be more tax efficient than mutual funds. What about owning individual stocks? So we touched upon this a little bit earlier. It also goes back to the video that I made a while back about separately managed accounts and doing some tax loss harvesting by owning separately managed accounts. The good news is that when you individually own stocks, they can actually be more tax efficient than owning mutual funds. Why? Because again, as I was saying before, and as I talked about in the separately managed accounts video or SMAs, you control the gains that are realized within that particular portfolio, or the manager does. You don't get taxed on the stock just because the price went up. You only own taxes when you sell. So that gives you the flexibility to be able to harvest losses and or defer gains. Plus, if you own stock until you die, your heirs can receive a step up in cost basis, potentially wiping out the entire tax bill entirely. And with individual bonds, it's a little bit different. So if you're earning taxable interest, like say, for example, from a corporate bond, you're still getting taxed every single year at your ordinary income, but you have a bit more control compared to bond funds, especially if you're buying and holding until maturity. You don't really face the same sort of capital gains distributions that funds can trigger when they're rebalancing or just dealing with redemptions. And of course, if you're in a high taxed area like New York or California, your municipal bonds or muni bonds can even help reduce tax drag further, since they may be exempt from federal and state tax. So to sum everything up, tax drag isn't necessarily about how much your investments can earn. It's about how much they cost you in taxes. The same $100,000 investment can grow very differently depending on whether it's in a high turnover mutual fund, a low-cost ETF, or a well-managed individual stock portfolio. Tax efficiency matters. Again, it's a common thing that I get from people, especially here in the Northeast, and for higher income earners. And over time, it could be the difference in compounding your wealth and compounding your tax bill. So as I talked about in the beginning of the video, let's look at a real example and try to bring everything together. So let's compare two funds. One's going to be a mutual fund. One's going to be an ETF from the same fund family, which is going to be Vanguard. We're going to compare the mutual fund VEIRX, which is called the Vanguard Equity Income Fund, and VTV, which is the Vanguard Value ETF. These are similar funds, or as similar as they possibly can be. Both broad, large cap value ETF funds. One is an actively managed mutual fund, and one is passive. The turnover in the mutual fund is roughly 40% versus the ETF, which is roughly 10%. The expense ratio is a little bit higher in the mutual fund at 19 basis points versus 4. So for a mutual fund, 19 basis points, pretty good. Obviously, 4 basis points is great, but the tax drag on the mutual fund is about 3.5%, roughly. For the ETF, it's about 78 basis points. Capital gains distributions are typically high in the mutual fund versus rare on the ETF. But that turnover, like we were talking about earlier in the video, is going to create taxable events. And especially the way that a mutual fund handles that turnover is going to again, what's going to drive tax inefficiencies. If we want to really compare the numbers, let's look at VIRX versus VTV. Let's look at the returns and then the tax adjusted returns over 1 year, 3 years, 5, and 10. What's interesting here is that if you look at the mutual fund, you can see that the before tax adjusted returns are actually higher than the ETF. But when you factor in the tax drag associated with it, you can see that the ETF had a little bit of a higher return than the mutual fund. If we look at 3 years, the returns were almost identical. But if you factor in the tax adjusted returns, you can see that the ETF did around a little bit more than 2% better. And you can see this across the years that the ETF just winds up being a little bit more efficient versus the mutual fund. Now, there could have been specific events that really triggered some of those high taxable events, but that's just the nature of the beast with mutual funds. And we're only talking about one fund. So if you have a diversified portfolio that has anywhere between 8 and maybe 20 different holdings, you could have a couple of these and you just didn't even know it. And again, that spread, 1%, 2%, 0.5%, it just can compound over time. Hopefully this example shows you what it is that I'm talking about. So how do you reduce tax drag? The good news is there's multiple ways to do this. And we've probably touched upon this as we've been having this conversation in this video. But asset location is a really big one. You can probably find hundreds of videos on YouTube talking about this. I should probably do a video about this in the future and really dive into it so you can see what it is that I'm referring to. So what I mean by this is you want to own tax inefficient investments inside of tax deferred accounts. So what we mean by that is mutual funds or bonds or even REITs. And then you want to own tax efficient investments inside of taxable accounts. So maybe broad-based index funds or ones that just don't have a lot of turnover. We also talked about the difference between mutual funds and ETFs and how they're structured and how they recognize gains and trades and things like that. So be cognizant of that as well. We talked a little bit about tax loss harvesting. Again, tax drag is a subset of tax loss harvesting. I think tax loss harvesting is really like the main topic, and then underneath is tax drag, which is just one strategy under tax loss harvesting. Fund turnover is the last thing that I'll comment on. Again, these funds that just have high turnover, those are going to be the ones that are going to produce a lot of capital gains, maybe few losses, again, depending on if it's a mutual fund or an ETF and things like that. So for some final thoughts, tax drag might not be like the most exciting topic that's out there, but the problem is that it plays a pretty big role in your overall returns, but you can't even see it. That's the problem and why it becomes so tricky. So one of the key takeaways that I would say to you is that it's not necessarily what you earn in a particular portfolio or what that actual return is. It's what you keep. So if you can work with an advisor who can figure out and help you with the tax efficiencies within a portfolio, you'll probably be in a much better place. And again, we're speaking about this more on the taxable account or just a traditional brokerage account that you might have in an E-Trade or Fidelity or with your financial advisor versus a retirement account. Hopefully you found this video insightful. If you did, please hit the like button. That helps our channel grow tremendously. We're always looking at what people are watching and not watching. Unfortunately, you can leave comments. That's due to compliance. Nothing I can do about it. I love you, compliance. But feel free to also reach out to us directly. You can email us. You can call us. We're always happy to have conversations and help people if we can. Please subscribe so that way you can stay up to date on any new videos that we put out, and we'll see you in the next one. If you're ready to take your financial planning to the next level with a customized approach, feel free to reach out to us. This way we can help determine if we can even help you or even point you in the right direction. The best way to reach out to us is through our website at sandersmith.com. Thanks for watching. For more valuable tips on financial planning, check out those videos here. And if you found this information helpful, please like and subscribe so you don't miss any future content.